It's time for the market prep video here on Stoncast. Markets are continuing to rip. We got some promising economic data that came out last Thursday. And by the way, the big, beautiful tax bill passed the House of Representatives, a major victory for Republicans. We'll take a look at it through the lens of traders and see what sectors you need to be paying attention to with this new bill being passed. We'll also break down key economic data coming out this week and a whole lot more. Make sure to like, subscribe, and follow wherever you listen to podcasts. And now, folks, let's get into it. Welcome back to Stoncast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Shar. I hope everyone had a fantastic 4th of July, and we are set for another major week in the market. The market is flying high and we got a lot of news to get into. So let's jump right into it. So first of all, I want to break down what happened last week. We had the shortened trading week closed on the 4th of July, of course, on Friday. But on Thursday, we had a shortened trading day, but it was a jam-packed day. The Dow jumps more than 300 points. S&P 500 sets new record after strong June jobs report, which we'll get into. But let's first of all take a look at the overall market. The S&P 500 closed at 6279 on Thursday, and folks, it is continuing to fly high. You had the S&P up nearly just over 0.8%. You had the NASDAQ, which was flying high as well. The tech-heavy NASDAQ was almost up a full percent, 0.98%. You had small caps up 0.9%, and the VIX down at 16 still. So things are flying high. One of the things that I'm paying attention to as it relates to the overall market, I'm using Fibonacci extensions to kind of get an idea of where this thing could be headed. Keep in mind that on a technical basis, we are extremely overbought right now. You got the RSI sitting at 75. I'm going to get into that here in a little bit for a potential short-term bear case maybe. But as far as some levels that I'm paying attention to, I basically took the Fibonacci extension, for those who don't know how it works, based off of the April lows that we had when the reciprocal tariffs were announced. And you basically take that up to the high and then the next low, and it kind of gives you some targets. It's pretty wild how accurate Fibonacci levels in general can work, whether it's retracements or extensions. So as I've said before, I'll say again, if you're not familiar with them, definitely look into them. They can be very handy when it comes to trading. So as far as some levels I'm paying attention to, I'm looking at 63.34 as the next level for the S&P 500. Beyond that, a little bit more bullish, 64.67. And then if you want to get real wild, I'm looking at 6,900, just below the next major level of 7,000 on the S&P 500. Not something I thought I was going to be saying back in April. Those are some of the levels that I'm paying attention to on it as we just continue to fly high. So part of the reason we flew high on Thursday was the fact that we got that June jobs report that came out. I'll break that down as far as, what that looked like and why it was so promising. But first of all, maybe the bigger news. House narrowly passes Trump's mega bill and major victory for Republicans. The House of Representatives on Thursday passed President Donald Trump's massive tax and spending bill, delivering him a major political victory and teeing him up to enshrine much of his sweeping domestic agenda into law. The final vote was 218 to 214, with 2 Republicans, Thomas Massie of Kentucky and Pennsylvania's Brian Fitzpatrick, voting against it alongside all of the chamber's Democrats. The bill at this time on Thursday when the article was out. The bill now heads to Trump's desk for his signature. Obviously, he's inked that. The legislation, which Trump has dubbed the One Big Beautiful Bill, contains trillions of dollars in tax cuts and beefed up immigration enforcement spending, and is offset by significant cuts to Medicaid and other programs. Republicans expressed confidence that the bill would pass, despite opposition and prior rounds of voting by a handful of GOP holdouts who warned that the package will exacerbate U.S. deficits. 5 of those Republicans initially voted no on a key procedural vote Wednesday evening to tee up the bill for final passage. Their opposition caused hours of delays, but 4 of them relented overnight and the motion passed around 3:30 a.m. So both House Speaker Mike Johnson and Trump himself heaped pressure on the naysayers to clear the way. A White House official told NBC News the president has spent months urging congressional Republicans to send him the bill by the 4th of July, and he got just that. So one interesting thing to note here that happened, which just blew my mind, U.S. House Minority Leader Hakeem Jeffries, Democrat, he basically decided that he was going to speak on the floor for 8 hours and 45 minutes as the House debated the One Big Beautiful Bill, essentially trying to delay it. That is very impressive. Obviously, he wasn't successful. The bill passed, but nevertheless, I don't know if I could talk on here for 8 hours and 45 minutes. So hats off to him regardless. So the Big Beautiful Bill did pass. And so, look, this is a trading show. This is a stock market show. I'm not going to get political here. I'm just laying out exactly what happened as far as the bill being passed. What I want to do is I want to look at this through the lens of a trader, through the lens of an investor, right? So I asked our friend ChatGPT, hey, in light of this bill being passed, what are some key sectors that we need to be paying attention to? What are some industries that we need to be paying attention to? Obviously, we know from the Trump-Elon drama, this is going to affect EV and some of that clean energy stuff. And so, taking a look here at some of the different sectors and things that we could be potentially paying attention to. Bullish sectors, so manufacturing and industrial. So benefits from 100% bonus depreciation and immediate expensing of capital investments. Corporate tax rates remain permanently lowered, improving long-term profitability and CapEx planning. Another sector to be paying attention to would be defense and aerospace. They received a $150 billion boost in spending, including funding for drones, missile systems, and broader military infrastructure. Also, financials and banking. Permanence of corporate and individual tax cuts may support consumer spending and lending growth. Loosened clean energy credits potentially drives reallocations into traditional energy and industrials. Also, energy, oil, gas, coal, nuclear. Phasing out clean energy tax credits tilts policy in favor of fossil fuels. Permits and subsidies for traditional energy plus expanded carbon capture credits boost energy majors like Exxon and Occidental. And then small businesses and pass-through entities are also going to benefit from this. Increased SALT caps raised to 40K, aiding high-income small business owners. So those are your bullish sectors that I would definitely have on your radar as this new bill becomes law at the beginning of 2026. These are definitely going to be some sectors that you want to have on your radar. Maybe find a few names that are beaten up in these sectors that could obviously benefit from this bill being passed, especially when we're talking about manufacturing and industrials and energy. I think those are going to be massive, and defense. Defense and aerospace is also going to be massive as well, in my opinion. Now, on the other side of the coin, bearish sectors, first of all, clean energy. So solar, wind, EVs, elimination of residential solar credits, EV tax incentives, and IRA clean subsidies threatens growth. Healthcare and hospitals, so Medicaid and food stamp cuts may reduce coverage for millions, diminishing demand for healthcare services. So keep that in mind. Hospitals are going to face revenue pressure and greater uncompensated care risk because of this. Also, low income and social programs, so SNAP and Medicaid enrollment down by millions. affecting retailers tied to these demographics and community health providers. So, basically, in a nutshell, here as a summary, manufacturing bullish, defense bullish, financial slightly bullish, traditional energy bullish, clean energy bearish, healthcare hospitals bearish, and then consumer retail's kind of mixed. So, what we could see here, equity traders may rotate into defense, industrials, traditional energy, and select financials. So, these are definitely sectors that I'm going to be paying attention to, really on both sides. Puts on clean energy isn't a bad idea heading into next year. Calls being bullish on, like I was saying, energy, traditional energy, oil, gas, stuff like that, defense, aerospace, manufacturing. Definitely going to be something you want to be paying attention to as we head into the new year to see how this is actually going to play out. But pretty historic. I had said on a previous episode, I highly doubted that they would get this bill passed before the 4th of July. And folks, they did it. So hats off to the Republicans. A great effort. They got it through. Trump got what he wanted. And now we get to see how it'll play out. As far as earnings impacts for overall just corporations, I think this is beneficial. And so we should see this reflect in earnings reports. So you'll want to pay attention to that. Now, as far as some of the hard data that we got on Thursday before we headed into the holiday weekend, U.S. payrolls increased by 147,000 in June, more than expected. So job growth proved better than expected in June, boosted by government hiring as the labor market showed surprising resilience and likely took a July interest rate cut off the table. I talked about it in the previous episode that we put out. There was about a 25% chance that we'd get a rate cut in July. That is completely off the table now, given the fact that we're still getting this hard data coming in that looks great. So it seems at this point in time, a 25 basis point cut is going to be officially pushed out until September. Non-farm payrolls increased a seasonally adjusted 7,000 for the month, higher than the estimate for 110,000 and just above the upwardly revised 144,000 in May, the Bureau of Labor Statistics reported Thursday. April's tally also saw a small upward revision, now at 158,000, following an 11,000 increase. As you can see here, for those on YouTube, this is the monthly job creation in the U.S. chart from January 2022 to June 2025. And we see that we came in at 147 in June. Starting to stabilize. We did have that low of 111,000 at the beginning of the year, and we've just been increasing ever since. Also, the unemployment rate fell to 4.1%, the lowest since February, and against a forecast for a slight increase to 4.3%, a more encompassing rate that includes discouraged workers and those holding part-time positions for economic reasons, edged down to 7.7%, the lowest since January. Though the jobless rates fell, it was due largely to a decrease in those working or looking for jobs. So, all that to say, we got some really, really good economic data that came out on Thursday last week, and that really just skyrocketed the markets. As soon as those numbers came out, we saw the S&P 500 climbing. You had tech climbing high. We even saw a couple of names I had mentioned on the previous episode, like Oracle. I mean, that thing just continues to freaking rocket. A new all-time high for that as of last Thursday, closed at 237, a new all-time high there. It was up another 3%. So, I mean, just the overall market right now is just insane. We continue to climb. We continue to get good data, and things are looking very promising. Let's do a quick check-in on the economic calendar for what we got coming out this week. So on Monday, we don't have a lot coming out on July 7th, Tuesday, July 8th, also not a ton coming out. And then on Wednesday, July 9th, we do get some important data. We got a 10-year note auction that'll be coming out at 1 p.m. Eastern. That's very important to pay attention to. And then we also got the Atlanta Fed GDP now for Q2 coming out also at 1 p.m. And then FOMC meeting minutes coming out at 2 p.m. Eastern. That's going to be really important. For those who don't know, this is going to be basically a recap of that last Fed rate decision. So we're going to get some insights into how the Fed is processing the data, whether they're leaning dovish or hawkish for the future. Again, I think we're kind of all expecting a rate cut in September at this point, but the Fed has held steady so far through this point in the year. We've already highlighted numerous times the fact that President Trump really wants the rate cut, and Jerome Powell, aka Daddy Powell, is not giving it to him. So as far as quantitative easing, it hasn't happened yet. So that FOMC meeting minutes that comes out on Wednesday, July 9th is going to be very telling. On Thursday, July 10th, we get a 30-year bond auction as well. That comes out at 1 p.m. And then earlier in the morning that day, we get initial jobless claims at 8:30 a.m. Eastern. So definitely want to be paying attention to those if you are a short-term trader. So here's the thing. When it comes to the 10-year note auction, 30-year bond auction, the last time those happened, they impacted the market negatively because they did poorly. So I, for one, am going to be paying very close attention to those auctions that happen this week to see how they do relative to the last auctions that we had. And then on Friday, we don't really have a lot going on there. So that's what you got for the economic calendar for the week ahead. I think that FOMC meeting minutes and the initial jobless claims and the bond auctions are really going to be the highlight for the week. So definitely have those on your radar if you are a short-term trader. Now, I just want to get into really the bull case and the bear case for the overall market right now, right? I think that a lot of people are just baffled that we've climbed this high after those reciprocal tariffs that were announced in early April. And trust me, it's been shocking. I've heard arguments on both sides as to whether this bull rally can continue or not. And so I just want to kind of cover that here briefly. So first of all, Thomas Lee, known as Tom Lee, for those who don't know, he is the co-founder and head of research at Fundstrat Global Advisors. He's a contributor to the CNBC team. And I heard a very interesting short clip that he put out last Thursday where he was just kind of laying out why he believes that this market is going to continue to fly high. He was essentially saying that, this market has been flying high, but he believes it's going to keep going higher. And one of the reasons for that is just simply the fact that the Fed hasn't even started cutting rates yet. The Fed has not released quantitative easing as of yet. And so you have this market strength that's been going on, and we haven't even begun to cut rates yet. Now, like I was saying, we are expected to begin to cut rates in September. And essentially what he was saying is that the minute the Fed starts to cut rates, it's going to be like a 12-month process at the least, right? Where there's going to be a lot of consecutive rate cuts coming. And so that's just going to, kind of fuel more money into the market based off of what he's seeing from a lot of his high net worth individuals, clients, is that they still have a lot of money on the sidelines. But as we see those Fed rate cuts taking place over the coming months, you're going to be forced into more of a cyclical cycle where a lot of money is going to flow into the market. And he was essentially saying it doesn't take a ton of money to move the S&P 500 up, let's say, 5-10%, that could be, I think he threw out a number, something like $10 billion, right? And he's talking, there's still trillions of dollars on the sidelines. He said that this is the most hated V-shaped recovery he's ever seen. You have a lot of investors that are skeptical about this rally. But as we get, again, that quantitative easing from Jerome Powell and the Fed in the coming months, he thinks it's just going to continue to push this market even higher. And you top that off with the fact that earnings for corporations are going to look better now, given this new tax bill that's been passed. So you add that onto it as well. not to mention the fact that we will be heading into, Q4 Santa rally. It's a great time of the year for the market in general. So he's fully expecting this rally to continue. He believes it is justified, that we are at all-time highs from the highs that we were at back in February, and that it's simply going to continue. So that is the bull case, according to Tom Lee. Let's take a look at the bear case. So I saw this interesting article from Benzinga, and they were essentially saying that if you take a look at the overall market, basically on a technical basis, usually when the market is overbought, meaning the relative strength index, the RSI, is over 70, which it currently is, that we typically see some kind of pullback that ends up happening. And so, essentially what they were saying is that we're kind of in a position right now where we could see that happen again. So according to Benzinga, according to this article here, if we take a look at a few of the last times that the RSI on the S&P 500 was over 70 and what actually happened. So July 2024, the RSI spiked above 75 and the index dropped 10% from 5660 to August 6th. July 2023, RSI flagged overbought and the S&P 500 slid 10% through late October. You got September of 2020 where the RSI hit 83 before a rapid 10% decline that same month. And then January 2018, the RSI hit 86 after a 7% rally. The index then plunged 12% in just 9 trading days during early February. And so they do point out that the RSI is not a crystal ball. In December of 2023, the indicator was also overbought, but the S&P 500, as tracked by the Vanguard S&P 500 ETF Trust, kept climbing and added over 15% until April of 2024. Similarly, in December of 2019, a reading of 78 did little to slow momentum until COVID-19. So basically, they're just simply saying that right now, the RSI on the S&P is overbought, and it's important to pay attention to because we might be due for a short-term, maybe even near-term pullback on it. And so, it's just something to definitely have on your radar. From a technical standpoint, the RSI is very important to pay attention to, in my opinion. It gives you a gauge on basically where or how much strength, I should say, is actually in the market. The RSI ranges from 0 to 100, and traders use it to gauge whether an asset is overbought or oversold. While it doesn't predict direction, history shows it often coincides with key market turning points. Just something to have on your radar. Again, right now, the RSI on the S&P is sitting at 74. If we take a look at the NASDAQ right now, the RSI on that is sitting at 71. And we also see this reflected in various individual equities as well. You had Meta, for example, that had actually touched 71 overbought territory beginning of last week. And then, as you can tell, it did sell off. It basically, the RSI just needs to kind of reset, needs to cool off a little bit, right? Some other ones to pay attention to, NVIDIA. This one right now, the RSI is at 71. Already talked about Oracle. This thing's at 80 on the RSI. So you have a lot of individual companies that are also technically in overbought territory, which makes sense why you're seeing the RSI on the overall S&P 500 sitting in that same space. So I say all that to say, I just kind of want to lay out the bull and the bear case right now. That's kind of what I'm paying attention to. I'm kind of more in the camp with Tom Lee. I think it makes sense when you talk about quantitative easing still yet to come, and the fact that you still have a lot of money on the sidelines that will start to come into the market, especially with the tax bill being passed now. So I think we're in for a continued bull run, but I wouldn't be surprised in the short term to see a bit of a pullback. So I wouldn't be too surprised about that. Let's see what we got coming up though for the week ahead. Make sure to drop a comment. Let me know what your thoughts are. Are we in overbought territory? Are we going to continue to fly high? Or are you just riding calls to the moon? Would love to get your thoughts on it. I will be back midweek, as always, Thursday morning, 8 a.m. for the midweek check-in. Thanks as always, folks. Make sure to like, subscribe, leave a comment, and remember, plan the trade and trade the plan. Have a good one.